Welcome to the 16th session of Management Accounting, 5th semester of BBA, Bangalore University. In this 16th session, we are going to discuss one problem on solvency ratios. Recap of previous class. In the previous session also we discussed solvency ratios concept and problem. So the next problem is like comment on the financial position of the company by using solvency ratios from the following balance sheets. So on the liability side, we have equity share capital rupees 2 lakh, reserves rupees 40,000, profit and loss account 60,000, secure loans 1 lakh 60, creditors 1 lakh rupees, provision for tax 40,000. So the total liability is 6 lakh. On the asset side, goodwill rupees 1 lakh 20, fixed assets 2 lakh 80,000, stock 80,000, debtors 40,000, bills receivable 20,000 and cash rupees 60,000. The total assets 6 lakh. So by using all these, we need to comment on the financial position by using solvency ratio. Means we need to calculate all the solvency ratio that includes. So the solution, so debt equity ratio that includes in the solvency ratio. So debt equity ratio is equal to total long-term debt divided by shareholders fund. Long-term debt is equal to, in this problem we have only one long-term debt, that is secured loans. So 1,60,000 will be the long-term debt. Shareholders fund is equal to share capital plus reserves plus P&L account. So share capital, equity share capital is rupees 2 lakh, reserves is 40,000, P&L account is 60,000. So the total is rupees 3 lakh. So then apply the values. Debt equity ratio is equal to total long-term debt 1 lakh 60 divided by shareholders fund 3 lakh. So the debt equity ratio will be 0.53. The next one, fixed asset ratio. The formula is fixed asset ratio is equal to fixed assets after depreciation divided by long-term funds. Fixed assets in this problem is rupees 2,80,000. So we need to find out the long-term funds. So the formula is share capital plus secured loans. Share capital is rupees 3 lakh plus secured loans is 1 lakh 60,000. So the long-term funds will be 4 lakh 60. Apply the values here. Fixed asset ratio is equal to fixed assets rupees 2 lakh 80 divided by long-term funds 4 lakh 60. So the fixed asset ratio will be 0.61. Next one, proprietary ratio. To find out the proprietary ratio, first we need the tangible assets. Tangible assets means which we can touch and see and feel. So I mean the fixed assets. So to find out those fixed assets, we need to less the intangible assets from the total assets. Intangible assets means which we can feel but we can't touch and see, like goodwill, copyrights, patents, trademarks, etc. So the total assets in this problem, that is rupees 6 lakh. Intangible assets we have only goodwill, so 1 lakh 20,000. So the total tangible assets will be 4 lakh 80,000. Here is one note: goodwill being intangible assets is reduced from the total assets. Okay. Next, total debt is equal to secured loans plus creditors. Secured loans is 1 lakh 60,000. Creditors 1 lakh is equal to 2 lakh 60,000 will be total debt. So apply the values here. Proprietary ratio is equal to shareholders fund divided by total tangible assets into 100. Shareholders fund, in the previous one we calculated it, that is shareholders fund rupees 3 lakh divided by total tangible assets 4 lakh 80,000 into 100. So the proprietary ratio will be 62.5%. Solvency ratio. Solvency ratio is equal to total debt divided by total tangible assets into 100. So we already know the values. So total debt is rupees 2 lakh 60,000. Total tangible assets is 4 lakh 80,000 into 100. So the solvency ratio will be 54.17%. Thank you. Have a nice day.